The transition from pandemic to living with the virus continues to take shape. But the economic recovery, whilst promising, remains uneven and elusive. Our latest thoughts a month into the new year. The reopening of our international borders on February 21st is a significant milestone, and the combination here of high vaccination rates, strong household demand, and very high levels for job vacancies should all combine favourably with a resumption of tourism, both domestic and international. The Omicron strain dealt a cruel blow in January to businesses, especially in the services sector, where the recovery post-Delta was just gathering pace. But the surge in Omicron cases does appear to be peaking, and labour markets remain as tight as ever. The latest RBA forecasts are for unemployment to fall below 4% this year, and show employment, after the second dip from the Delta lockdowns, with no expected fall in aggregate employment from Omicron, although a noticeable fall in hours worked. This suggests that demand remains high, which, once Omicron numbers have levelled off and as booster shots provide their protection, should see employment and hours worked march steadily higher as the economy rebounds. The reopening of borders to overseas workers will also help with the Omicron wave disruptions, as businesses deal with shortages in labour supply. An unemployment rate below 4% will be the lowest since the 70s, and this trend is being seen all around the world, with record low unemployment today in New Zealand, the Eurozone, and in a dozen US states. Other RBA forecasts in their latest monetary policy statement include GDP growth of 4% this year, on top of 4% in 2021, and core inflation to rise above 3% by mid-year, the first time the RBA has faced an above-target inflation scenario since the GFC. As the chart shows, our consumer price index is much lower than most countries around the world, only up at 3.5%. But inflationary pressures are showing no signs of easing, including from tight labour markets. The RBA remain unconvinced that this will be a major issue for our economy, insisting that our lower rate of inflation and low wages growth mean there's no need to tighten interest rates yet. But if and when the unemployment rate does fall below 4%, then wages may well surprise on the upside. As we suggested in our updates through the second half of 2021, the prospect of falling unemployment, the success of fiscal policy, and the resilience of household demand all point to our economy recovering once pandemic restrictions are lifted. But we also suggested that rate hikes in the second half of 2022 would be consistent with this timing and with rising inflation. Most central banks have either started lifting official rates or, like the US and Canada, are on the cusp of a tightening cycle. And while the RBA are only suggesting rate hikes later this year are plausible, we've brought forward our base case for the first rate increase from November to August. The path to a neutral official cash rate around 1.5% may be gradual, and, if accompanied by wages growth, can be benign. But what higher interest rates mean for property values is a hot topic. Our expectation for residential property is for it to only grow around 5% this year, down from the 21% rate last year, but still with regional property outperforming the capital cities. And lastly, for stock markets and exchange rates, the interest rate outlook is adding volatility to financial markets. But based on the relativities of our economic outlook, including strong domestic demand, brisk retail sales, and high commodity prices, our markets may be much more stable than elsewhere. And that's the market update from Bendigo Bank.